The International Monetary Fund stood up and said, "The world economy is heading into the worst economic headwinds since World War II. This could be bad news, but depending on how you look at it, it could also be very good news." In this video we're going to talk about a few metrics which point out that we're going into a recession. This is not clickbait. I could be wrong, but historically speaking these metrics indicate that the stock market will crash maybe 50% or even more. Without hesitation, let's get right into it. The first metric is the 10-year cyclical adjusted PE ratio. This is the price-earning ratio based on the average inflation-adjusted earnings from the previous 10 years. Historically, the median is 15.88. Today, the 10-year cyclically adjusted PE ratio is 32, which is twice as much. The next metric is the price-to-sales ratio. Current price-to-sales ratio is estimated based on the current market price and the 12-month sales. Historically, the median is 1.54. Today, the price-to-sales ratio is 2.65, which is 70% higher. The third metric is the stock market GDP ratio. Warren Buffett remarked, "It is probably the single best measure of where valuations stand at any given moment. It is a measure of the total value of all publicly traded stocks in a country divided by that country's GDP. Historically, this number is around 85%. Today, the market GDP ratio is 165%, which is once again is double. The fourth metric is the ISM Manufacturing rate. The ISM Manufacturing Index, also known as the Purchasing Managers Index, is a monthly indicator of the US economy activity based on a survey of purchasing managers at more than 300 manufacturing firms. It is considered to be a key indicator of the state of the US economy. Below the 50, the economy is getting weak. A recession comes about 47. Today we're at 52.8 with a recent high of 64, which indicates that the state of the US economy is stagnating. The last metric is the combination of the raise of interest rates, inflation and oil. First, let's take a look at the inflation numbers. Inflation is a recurring factor when it comes to recessions. Every time we see a spike in inflation, a recession follows. The Fed raises interest rates in order to fight inflation. You normally want inflation to be just over the interest rates. Every time the Fed raises interest rates, we can see in the gray areas that the recession followed. We also have seen a huge raise in oil, from $23 to almost $120. A huge increase in oil price historically indicated that a major drop occurred and a recession followed. But where are we now? If we take a look at the S&P 500, we can see that since 2022 there's a drop of around 25%. In the last 1.5 to 2 months we rallied back up. I believe they were just at the end of a dead cat bounce. This means that we're possibly setting up for a big fall. But as I mentioned in the beginning of this video, this could be bad news, but depending on how you look at it, it could also be very good news. Bull markets make stupid people look smart, and all the stupid people who think they're smart are going to find out how stupid they are. Be fearful when others are greedy, and be greedy when others are fearful. I'm not scared, because this recession will be the biggest opportunity of your life. I will still dollar cost average into my portfolio, because remember, time in the market beats timing the market. I hope you guys liked this video. Check out my other video where I show which 2 dividend stocks I bought. Be sure to subscribe to the channel if you haven't already. Thank you for watching, and I'll see you guys in the next one.